Welcome back. Let's do a quick update on the market. First of all, not financial advice. Consult your licensed financial advisor before doing anything. It's more of an educational channel on trading, economics, and just listening to me rant and give my opinions, which may be all wrong. Do not invest anything you're not willing to lose or lose sleep over. Stocks, bonds, currency, all extremely all volatile. Alright, so just in case my channel disappears, both of them, two, on this platform that you are watching, go to this one. Okay, this is the alternative. Just type in MMG_invest, just in case. I mean, they shouldn't go after me because I really do keep my mouth shut, but just in case, because I don't know, at some point they're gonna go after everything. The only thing left will be nothing, unless things change, and I don't know. We're about to find out in the next 4 to 5 weeks, right? Also, I still have the holiday sale going on. Go to MMGinvest.com. Click on this, you add it to your cart. Normally it's $220, but you get a 40% discount for a limited time. I'm not sure when I'm gonna end this sale, but you can save 88 bucks, 132, and then I send out an email the next day, and then you sign up, and it's 10 bucks a month for the updates. You have to click all the disclaimers and all that. But you also have to click apply discount code. So read the disclaimers, no refunds, because you get all the information. Alright. The market, it took a big dump yesterday, the day before, which is what I was expecting, right? I put on that short, I even said in my last video, it's up nicely. Let's talk about current events because they matter. They're going to affect the markets, I believe. Not always, but this time around, things are getting spicy. China is buying up metals more than usual. I don't know what they're preparing for, but, you know, speculate. This is the newsroom. This is free, by the way. Anyone could join. Links below the video. Things here I can't talk about. There's a star, some sort of alignment. I want to talk about this. This is weird. Council for Inclusive Capitalism VI the Vatican. So they're consolidating more power, $10 trillion worth of institutions, roll out some sort of new economic regime across the planet. Will they try? Yes. Will it succeed? Highly doubt it. It's unsustainable. So things are really heating up. So uncertainty is definitely coming in the coming weeks. Which is gonna accelerate, I believe, the market, right? Oh, look at this emblem. Sort of the IMF. Look what's in front, look what's in the back. Elon Musk's rocket crashed or blew up. Digital economy disruption possible as Terminator event. Basically, solar flares are going to pick up this decade. Meanwhile, we're moving towards a cashless society. That's going to work out well. Used car prices in the US. So this is a little, it's not that simple, because when the Fed comes out and they actually pass stuff, it's going to be after the final inauguration. That's when the printing presses are going to get turned back on, and then used car prices might go back up, especially with refunds towards spring, right? It's seasonal for used car sales, and they always jack up the prices around spring. But right now the prices are really starting to drop off a cliff. It's completely dependent on unemployment benefits and stimulus checks and stuff like that. The economy, it's not going to get better anytime soon. So, but there's still a huge inventory of vehicles on the market, this huge glut. So you just kind of have to time it right within the year. So once the unemployment and the stimulus wear off, and the prices start dropping again. It's basically how this game works. So you have to be patient and time it right within every year. But overall, I mean, prices should drop. But then again, if inflation takes off, then in the long run they won't. So I say, I mean, it's up to you. You just have to time it right. And I'm sure there's a lot of desperate people out there selling vehicles below the rigged Blue Book and, you know, used vehicle website market. And trust me, they're all rigged. It's like everything else in life at this point. I'll talk about energy. It's not that simple. Some guy commented about energy. Listen, it's not that simple. U.S. household wealth hits all-time high. As top 1% have never been richer, while poor drowned in debt. Correct. I'll talk about the bond market. Yeah, this is weird. I'll post this in the newsroom. You guys can read up on it. What else? That's about it for the news, I guess. So, is the market going to continue to correct? I think so. And it's because of the political environment, and people are pissed. And everyone is kind of expecting something, referring to unrest. That's gonna happen, unfortunately, which I don't think is good for the long run, because especially if it gets drawn out, because the US has to be strong because of let's just say other rising empires who had a lot to do with this year being catastrophic for the US. Okay. But if we look at the next like 5-6 weeks, right? Besides my technical analysis telling me everything is very overextended, margin debt is just, I mean, the exuberance is off the charts. If you look at these charts, margin debt also confirms the correction in the recent exuberance. Like I said, guys, this is a major cycle, multi-year cycle. From 2008 till the current, from a bird's eye view, we haven't had a crash. Like what happened in March in 2020 wasn't a crash. In the grand scheme of things, it was just a correction, and the Fed saved the day and put in the backstops. I think we're gonna get another correction soon. If it didn't start this week, but I'm holding on to my short positions, which is through inverse ETFs. But in the grand scheme of things, I mean, it's the economy is just unemployment numbers came out today again. Another 850,000, almost a million people filed for unemployment. I mean, this decoupling of Wall Street from Main Street and reality and the real economy, it's just unheard of. I mean, you know, like decades from now, it's gonna be in textbooks, and people are gonna say to themselves, "How didn't they see this?" Well, I mean, people are. Honestly, I can't explain it. Actually, I can. Wall Street doesn't care about real economy. They only care about the Fed, and that's pretty much it. It's just a giant bubble and a bunch of worthless ones and zeros. So, but I mean, it's really overdue. It really is. Just looking at it from a multi-year. So before we dig further into what margin debt tells us, by the way, who's the author? Authored by Lance Roberts via realinvestmentadvice.com. Everything is at an all-time high. Before we dig further into what margin debt tells us, let's begin with where we are currently. Greg Fearman recently summed it up nicely. Friday was an absolute breakout to new all-time highs. That was last Friday, all-time highs. The S&P 500 closed at the new all-time high just below 3,700. The Russell tacked on another 2.37% and closed just below 1,900. Junk bonds and regional banks are super strong. Of course, if the indexes are breaking out, so are a lot of individual stocks. He is correct. As we discussed in sign everywhere a sign, investors are now all in terms of portfolio risk. You have to keep in mind, we haven't seen any real stimulus in a while, like 6 months. And if all the retail investors are all in, where's all this money going to come from? If foreign investors are all in, and not just that, I mean, with the political tension, right, in the US, and after that, we're going to get foreign tensions. It's a perfect storm with everyone margined up to the gills of retail investors chasing Airbnb and all these other stocks and tech stocks and everything else. It's just in the market, what it does, and the smart money, what it does, is it punishes the most people it humanly can. And the most people are at extreme greed levels and margined up and chasing this thing at all-time highs again, while the real economy is essentially destroyed, and the blue states are just locking down again. I mean, this is insanity. And they can't pass any stimulus or infrastructure spending or anything until this political tension is resolved, and it's only heating up. So what is the market pricing in? I don't know. I mean, they have to be pricing in I don't know. It doesn't even make sense. They're pricing in the Fed's gonna just dump another 10 trillion and not let the market even correct. That doesn't even make sense. So just the odds of timing and everything going on, it's a very common sense trade. of not being long and being possibly short. So I guess it's fear of missing out, right? It's again, the Wall Street cheat sheets chart. It's this time's different. Euphoria, essentially. That's the only way I could explain it. As Howard Mark noted in a recent Bloomberg interview, fear of missing out has taken over from the fear of losing money. If people are risk tolerant and afraid of being out of the market, they buy aggressively, in which case you can't find any bargains. That's where we are now. That's what the Fed engineered by putting in rates at zero. We are back to where we were a year ago. Uncertainty, prospective returns that are even lower than they were a year ago, and higher asset prices than a year ago. People are back to having to take on more risk to get a return. Again, you know, a lot of these hedge funds and institutions, their bonuses rely on like quarter to quarter performance. So they never look past this quarter, the current quarter they're in. They only care about their bonuses for the end of the quarter, and that's why they're always biased towards a bull market, and they're never and that's how they're competing with one another, because you're a fund manager, you're gonna get laid off if you don't perform quarter after quarter. At Oaktree, we are back to cautious approach. This is not the kind of environment in which you would be buying with both hands. All right, the issue of margin debt. This is exuberance. I've talked about margin debt. I mean, if you open a brokerage account, they automatically just give you margin, which is, I mean, it's very reminiscent of mortgage-backed security crisis. Like, everyone just leverage up. And that's the environment that the Fed creates, right, with artificially low interest rates. You can't make money in this environment without taking on a ton of debt to try and risk to try to make more money. And it's all going to come crashing down once the dollar really starts plunging. So event risk. It is when an event causes leaders to panic. That margin becomes problematic. We have seen margin liquidation events twice in the last 15 years. The first was during the 2008 financial crisis that forced Lehman into bankruptcy. Right. I mean, so back in 2008 when Lehman went under, before Lehman went under, like 8 months prior, there was a huge market correction. And again, that is very reminiscent. So what, like 8-9 months ago, we had the huge correction because of COVID, right? During March in the markets. It wasn't until like 8 or 9 months later that huge institutions started filing bankruptcy and started going under. A good movie to watch is, what is it called? I think it's Margin Call. That one portrays it, and so is The Big Short. But Margin Call is better to understand that. And I guess what is it? What's the other movie? Wall Street, but the second one, the second Wall Street movie. It came out, I think in like 2011 or something like that. By the way, I didn't read this article, and you know, I'm just saying these things out loud, and then this article is literally backing up what I'm saying with charts and data. Funny. They're relating it back to 2008, what happened, like the March chart. So here's a good chart. There are two reasons. The Fed rushed to the rescue of the banks again. A credit risk went parabolic, and the chart below of the free credit balances shows a massive liquidation of margin debt as brokerage firms called in credit lines. Now this was actually starting in 2009 when we had the repo debacle, right? Which ironically, in quotations, lined up with the cold that went around at the beginning of 2020 during the winter. The sales just, you know, perfect timing for everything. Look at this. 1987. Here's the dot com bubble. So the blue bars is margin debt, and then liquidations is the orange. So 2008, everyone took on a ton of margin. Wait, margin debt and free cash balances. So this is actually I was wrong. So free cash balances is the green. So that's just like cash you have in case of a rainy day. And then the orange is credit, debt. And then when you get a liquidation event, so a sharp correction in the market, what happens is firms, institutions, hedge funds, and businesses and corporations, they can't meet the margin call requirement, even retail investors, everyone, because they don't have any cash savings to meet it, right? So your portfolio, your account goes negative, and then you just don't have cash. So what ends up happening is everyone has to sell everything to meet their negative equity in their account, and that's when things blow up. And yeah, beginning of 2020 here, things blew up. It started in 2019 though. That's why we were doing repo, if you remember. Look at this. So they're gonna come out with the helicopters and bombers of cash, the central banks. They have to. Actually, the ECB today or yesterday announced another 500 billion. 500 billion is half of a trillion for Europe. Okay, half of a trillion for Europe is like 3 or 4 trillion for the US, because their market is much less liquid. Their economy is, I don't know if it's smaller, but it's probably almost the size of the US combined. But because not the world doesn't use the euro, the world uses the dollar for now. And when you print up 500 billion, that the velocity of that euro is much higher because there's less of a market for euros, period. That makes sense. So I expect the euro to drop versus the dollar. Take a look at this chart. See the correlation between S&P, the markets, equity markets, versus cash on hand and credit, margin debt. So dot-com bubble. Look at they had zero cash, ton of margin debt at the peak. Same back in 2007, mortgage-backed security crisis. And check this out. This, you can see the correlation perfectly. It's perfect. Markets, you know, everyone's like, you know, the market's gonna just melt up. And yes, I agree. It is very possible. But in order for that to happen, the currency, the central bank, is going to be sacrificed. Or the currency is. So we're due. I mean, can this be the big one? Yeah. You don't know until it really happens. We'll know. Okay, so if, I mean, the S&P falls below or no, this, we'll look at the S&P. But I mean, it's the correlation. You can't ignore this. No one should be ignoring this right now. All right, here's S&P. Free cash balances versus S&P 500. You see the negative equity here, the margin balances correlate with the correction. Blue line's S&P 500. The green again is cash on reserves, like. So I mean, soon. I'm willing to say 2021 at some point, this market's probably gonna crash. If it's not started like this week, it might be the big one. Now I'm thinking, you know, if let's say it did start this week, it's gonna fall for a while, but the PPT plunge protection team is gonna come in. So is the Fed, and they're gonna prop it up. But maybe later, like midwinter into the spring or maybe summer, it won't matter because because the currency will be losing so much value if they keep printing, and then you're just gonna see massive margin calls, firms going under. And let's face it, the economic data can't be getting any better in 2021, especially if what's his name gets in the house, the white one, and just locks us down and then never unlocks us, right? And not just that, I mean, civil unrest is gonna explode in spring and summer, just explode, and that would also be a great catalyst. So time's running out, guys. Not good. So, I mean, there's a bunch of charts. This is really good data. I mean, look at option speculation index. Everyone's long. I put on a bunch of puts last Friday. And then I put on more Monday. So, what else? I'll post this in the newsroom. I promise I won't forget. Yeah, I just got a notification. Dow ends lower on concerns over recovery as jobless claims surge. Oh, really? Reality's starting to set in? So, gold and silver dropped as I expected. VIX hit my blue equilibrium line, as I said in my last video, and then it bounced. I bought some calls on the VIX. Very profitable trade as of now. This is a weekly chart. Let's take it to a daily. I literally bought the bottom. Yeah, I mean, just a move from like $19.96. I mean, I didn't buy this VIX. I bought another VIX, a 2X VIX ETF that tracks it up. I don't know, a lot, probably like 20%. With the call, you know, with the call option, then it's up like more, a lot more. So I really leveraged on my short, but I didn't put on a large one because it was cheap. There's no if you're early, putting on options are cheap. So if you're late, that's when you start paying a premium for it. Let's we'll look at the dollar real quick, and then we'll look at bonds, and then we'll look at metals. So here's the dollar daily chart. Dollar finally put in a bottom here, the swing low, mainly because the market started correcting this week. I told you guys that was going to happen. And that's another reason why I think they let it happen. The Fed's okay with it because they're like, it's a game. You can't let the dollar just keep dropping. So you're like, all right, well, we'll let the market drop this time. Another, you know, nice correction. And then the dollar catches a break, puts in another support, and then bounces, rebounds. And then they come out with the printing press, Then they prop up the market. Same for that. You put in the bottom, and then it rebounds, and then it's like a game. They just keep playing until you can't play the game anymore, and reality hits you freight train. And the debt keeps in the background. The debt is constantly growing at a compounding exponential pace. So that's what's going to end the game, and that's what everyone just forgets for some reason. All right, so the 10-year yield, it hit, again, I talked about this, 1%. If it spikes, the market's going to correct hard, and I think that's possibly what's going to happen here. And it might actually get up to that 1.45, 1.5% on the 10-year, which is not high historically speaking, but it's high if you have an entire economy market propped up on debt and margin and you name it. All the smoke and mirrors. I'll talk about energy. But let's talk about gold real quick. Beautiful, beautiful bull flag. But again, let's... This is silver. By the way, it looks just like gold. Look, if there's going to be a correction in the market, it doesn't matter. Everyone's forced to sell everything because of margin calls, right? Because they're over leveraged. That includes your mining stocks and metals. They just hit a button and everything gets sold. So short term, just like it happened in March, sharp drop in metals. I expect it. There's a major support area around 20 bucks. 21 bucks and 20 bucks. It might go lower for a split second, a few days or something, but that's where you're looking at major support, and I would start accumulating again, going backing up that truck. And that's your last opportunity before the train leaves the station. After that, it's just hold on tight for the next like years, or half a decade or decade. I don't know. We'll see. And I'm telling you guys, let's just say foreign empires need to expand because of their population and minerals in their own country, and if things pop off like physical conflict globally, that's also very bullish for metals. Very, very bullish. Besides, you know, the possible currencies hyperinflating. And by the way, everyone's like, oh, they're just going to go to a digital crypto global. Yeah, if people accept it, but why would they? It's no different than the current digital dollar we have. Like 99% of like, or 97% of all dollars and all fiat currencies all around the world are digital right now. It's not that big of a difference. The only difference is they can control it better. That's about it. So they trap you. But that's it. But if people don't accept it, they're shit out of luck. So the only way they might get away with it is if they back it with metals in the beginning, and then as the years go by, again, they start detaching from metals. So either way, metals is the ultimate wealth transfer. The beneficiary of this wealth transfer is going to happen. Besides land, and I talked about that in my last video, right? Which is going very well. There's a lot of us. We could raise a decent amount of money. I mean, we could probably get 100 acres minimum. Like, I want like 150 to 180, maybe something like that, if not higher. It all depends on how many people and how much we could all raise, right? But it's going good. I was hoping a few more people would join. If you're interested, it's a vacation retreat, the safe space. I do want more people, so we'll wait a few more weeks and months, but we're planning. And I think the land in certain areas is going to go up in value. while the land in other areas are just going to drop off a cliff. So you want to be, and it's already happening. The prices are starting to go up already. So time's not on your side, and it's first mover advantage. Although I do want to wait for these mining stocks to go up this spring, so I don't have to sell stocks and liquidate some of my portfolio to invest, right? Like, so I'm trying to time this out perfectly with our own portfolios in the market, so we have as much money at that time to, you guys understand what I'm saying. All right, so here's gold. Major support. Again, I said this 2 months ago, if not 3. I'm looking for a correction down to 1750. We already kind of hit it. I mean, we already hit it. It went to 1762 like a few weeks ago, like a week and a half ago, something like that. Well, I think during this market correction, we're definitely going to hit 1750. And major support is around that 1760 area. But temporarily, it's probably going to drop to 1700, 1720. I guarantee. I bet. I don't want to guarantee it, but I bet it can. It depends on the velocity of the market correction for the broader markets, right? The S&P, Dow, the Russell, all of them, right? So it all depends on the velocity of that correction for the broader market. If it's the big one, it could go lower. Then gold could go lower than 1700. It could go all the way back to 1600. So be careful if you have margin or whatever. If you have a margin account, you got to raise cash. You got to hedge against metals falling and the broader market falling, having a hard correction, because you don't want to get wiped out during that event, because you get a margin call. So I'm warning you. I don't know if it's going to be that bad, because I don't know when the Fed is going to step in and willing to step in. I do bet they will step in before they let the market do something crazy like past a 30 or 40% correction. Although, I mean, the last one, right, for the S&P, let's look at the NASDAQ. It's going to come down to the NASDAQ, because that's where all the money's at, because the big tech stocks, the FANG stocks, right? So just look at the comparison. This is a monthly chart. By the way, the monthly, I have an 8 count on the monthly for the NASDAQ. That means next month we have a 9 count correction. And this indicator is cash money accurate. I'll give it 70%. That's all I need, because I have my other indicators and everything's lining up perfectly. Again, like it did back in towards the end of 2019, beginning of 2020. I called that as well. Let's go to okay, so the last correction was a solid about 32-33% correction. Well, this correction is definitely going to hit my blue equilibrium line and maybe overshoot it. What would be another like 30% correction? It could easily take you around 8,800 on the NASDAQ composite. Ticker is IXIC. And then again, another rebound. So, boom. And then Fed steps in, and boom. Will it make a new all-time high? Will it rebound all the way back to the previous all-time high, which we just had last week? I don't know. I let the market tell me what it's gonna do. I'm not a prophet. This might just turn into a little dead cat bounce, or a failure to rebound and make new highs, right? And then we might look something like this. And then we get the real big one. But that will take us into 2021. Later into 2021. Like spring, summer, something like that. Or maybe they do juice the market enough and it does make new all-time highs. I don't know. We'll figure it out when we get there. Alright, but this is, for right now, this is what I am worried about. Well, I'm not worried, I'm just anticipating. This is what I'm excited about. Because my positions, and then we'll see how deep this correction will be. I'm assuming. I'm hoping. I could be wrong. Consult your licensed financial advisor. Alright, let's take a look at energy. By the way, I shorted Tesla. Screw it. And dumped. I put that out in the alerts, yeah. Where is energy? Oh, here's Tesla. Yeah, I'm already at 41 minutes. I used to be able to make 30-minute videos, but there's just so much going on, you know? I mean, it's still holding on. Remember, they had that stock split. So this is like, it's, let me put this into perspective. In October of 2019, so we're looking at the price of shares after the stock split, a share of Tesla was $44. Right now, it's around 634. Now, do you think Tesla is just making more cars and selling more cars to justify that? No. No, not at all. So what is going on? Well, you have a bunch of dumb millennials. Just, I don't know. I don't know. I don't know what's going on. It's like getting washed straight to the sky. If the market corrects, Tesla's gonna correct as well. Okay? That's all I gotta say. It did rebound a little bit today. Today I was running errands, I wasn't watching the price. But went from 650 something, it fell to 560, so $100 drop. Almost $100. Alright, let's take a look at energy. Here's WTI crude. So it's had a nice bounce. I remember when I put on a bunch of call options for the private members, like when oil went negative. Some of those made a profit, not much, but I mean, one did. It's had a good run. It's coming up on major resistance. It's coming up on the 100-week moving average, and then there's major resistance at 50. It's at 46.84 right now. Now listen, if they're gonna do another lockdown, I mean, it's gonna dump. If economic data keeps worsening, crude, you would anticipate less travel, less businesses operating and needing energy, so you would anticipate that the price of oil will fall. Short term, meaning next few months or 6 months or something, or it might trade sideways. I think it'll trade sideways. But when the market corrects, it'll probably sharply drop back down to like 35 bucks or something. But I think it'll trade sideways in a range for some time, mainly because once the Fed comes out more stimulus and QE to prop up the market, then energy is going to have to price in the falling value of the currency. And that's how I think this is going to play out. And then by summer 2021, and also if the orange guy wins, right, I think everything will be, the lockdowns and everything will be gone, and by summer it's kind of going back to normal. I mean, maybe people will just, I think people are just, everyone's going to go on vacations, and then maybe temporarily there'll be some sort of euphoria, as in everything's going to be okay, like midsummer or something like that, going into fall, and then more and more worse economic data will come out. Because, listen, the damage that was done this year, we haven't felt it yet. I mean, a lot of people have. Millions, tens and tens of millions have lost their jobs, but they're getting unemployment. I'm saying the economic decay and the real feel of it is going to start hitting in 2021. While at the same time, it all depends if lockdowns, it depends on all sorts of things. So stay tuned, watch my videos, find me on my other channels everywhere, and we'll try to play this, right? But the long term, by 2022, I mean, it'll be very evident that the economy is in the dumps, all right? By then, inflation's going to be much higher too. So right now with oil, I'm just not touching it. I don't have any positions on. I'm just gonna watch and wait, see what happens with this market correction that I am anticipating, which I could be wrong. This is my theory, my what I'm thinking may happen here because of all of the evidence I've shown. All right, guys, smash some likes, leave anything in the comment section. Join the private group, huge discount, limited time. What else? Join my free chat groups, the newsroom. Find me on other platforms. And take care.